What if the Fed didn't need to cut rates at all to completely change how you think about buying a home this year? Almost nobody notices what just happened behind the scenes at the Federal Reserve, and it has nothing to do with the headline number everyone keeps watching. A quick thing before we get into it. If you find this useful, hit like and subscribe to the Daily Finance because we break down exactly what's happening with your money every single week. Now let's get into it. Here's where most people get the story wrong from the very first sentence. They hear the Fed, and they immediately think about one single number, the federal funds rate, and they assume that number is the same thing as their mortgage rate. It isn't. And understanding why it isn't is the key to this entire video. Right now, in the middle of 2026, the Federal Reserve has held its benchmark rate steady at a range of 3.50% to 3.75%. That's the rate banks charge each other for overnight loans. It matters, but it's not the number that shows up on your mortgage paperwork. Mortgage rates are actually tied much more closely to something called the 10-year Treasury yield, which moves based on what investors expect will happen to inflation and the economy over the next decade. Think of the Fed's rate as the temperature in one room of a house, and the 10-year Treasury yield as the thermostat that actually controls the heating for the whole building. The Fed can influence the thermostat, but it doesn't set it directly. That single distinction is why so many people have been confused this year. But that's only the beginning of what's really going on. Here's where things become much more interesting. In May of 2026, a new man took over as chairman of the Federal Reserve. His name is Kevin Warsh, and he replaced Jerome Powell after Powell's term ended. Warsh isn't new to the building. He actually served on the Federal Reserve's Board of Governors once before, back during the 2008 financial crisis. So he watched up close what happens when the housing market and the broader financial system come apart at the seams. That experience shapes how he's approaching this job now. And here's the detail that changed everything for how markets read the Fed going forward. Warsh has made it clear he isn't going to hand out what economists call forward guidance. That's the practice of a central bank openly telling markets in advance what its next move is likely to be. For years, that kind of guidance helped investors and, by extension, mortgage lenders plan ahead with more confidence. Warsh has stepped away from that. At a gathering of central bankers in Portugal earlier this month, he referred to the next rate decision as a family debate, something the Fed will work out internally rather than tip its hand about publicly. Think about what that means if you're a lender trying to price a 30-year mortgage today. You're no longer getting a clear signal about where things are headed. You're working with more uncertainty than lenders have had in years. And that uncertainty is a big part of why mortgage rates have been bouncing around instead of settling into a clean, predictable trend. But that's not the only piece of this puzzle. Here's an unexpected fact that surprised a lot of people who follow this closely. When the Fed released its June policy projections, it turned out the committee itself was deeply divided. Of 18 Fed officials who submitted their rate forecasts, 9 expected at least one more rate hike before the end of the year. 8 expected no change at all, and 1 expected a cut. That's about as split as a policy committee can get. And Kevin Warsh, the chairman himself, didn't submit a projection at all. He left his own number out entirely. For someone running the meeting, that's a notable thing to do. It tells markets, in effect, I'm not ready to commit to an answer yet, and I'm not going to force this group toward one before the data is in. If the person setting policy for the entire country isn't sure which way things are headed, you can imagine why mortgage lenders and homebuyers are having a hard time getting clarity too. Now here's where we connect all of this directly to your mortgage rate, because this is the part that actually matters for your decision about buying a home. As of mid-July 2026, the average 30-year fixed mortgage rate sits right around 6.5%, according to Freddie Mac's weekly survey. That's actually higher than it was back in early April of this year, when rates briefly dipped closer to 6%. What pushed rates back up? A combination of rekindled tensions in the Middle East, which sent oil prices higher, and inflation data that came in warmer than hoped. Higher oil prices tend to filter into broader inflation expectations, and higher inflation expectations tend to push the 10-year Treasury yield, and therefore mortgage rates, upward. That sounds like a small technical detail. It isn't. It's the actual mechanism connecting a conflict thousands of miles away to the interest rate on your mortgage application. And it's a perfect example of how many moving parts actually determine what you pay to borrow money for a home. Here's a pattern interrupt worth pausing on. A lot of people assume that if the Fed simply cut rates, mortgage rates would drop by roughly the same amount. That's a myth. Historically, each quarter-point cut in the Fed's rate has translated to something closer to a tenth or so of a percentage point move in mortgage rates, not a one-to-one match. So even if the Fed does eventually lower its benchmark rate later this year, don't expect your mortgage quote to fall by the same amount. The relationship is real, but it's loose, not exact. So where does that leave mortgage rates for the rest of 2026? Multiple major forecasters, including Fannie Mae, the Mortgage Bankers Association, and Freddie Mac itself, expect the 30-year fixed rate to hold somewhere in the low to mid 6% range through the remainder of the year. Nobody is projecting a return to the 3% rates people got used to during the pandemic. Most economists don't expect that kind of rate again in the foreseeable future. I want to be clear here. These are forecasts, not guarantees. Rates can and do move on short notice when new data comes in, as we just saw with the swing back up in April. But here's where almost everyone gets the bigger picture wrong. They focus entirely on the rate and forget to look at what's happening with actual homes for sale. This is where the story gets a lot more encouraging for buyers. And it's the part almost nobody is talking about. Housing inventory, meaning the number of homes actually listed for sale, has been climbing for more than 2 years straight. As of the most recent data, active listings sit somewhere around 1.5 million homes nationally, according to the National Association of Realtors, marking roughly 30 consecutive months of year-over-year inventory growth. That's a meaningful shift. During the tightest years of the pandemic-era housing market, buyers were often competing over a fraction of that supply. More available homes means less pressure on buyers to make a rushed, panicked offer the moment something hits the market. It means a bit more room to negotiate, more time to think, and in some regions, actual leverage that buyers haven't had in years. But that's only part of the picture, and here's the contradiction that trips a lot of people up. Even with more homes on the market, prices haven't fallen. In fact, the median existing home price has now posted more than 35 consecutive months of year-over-year gains, sitting somewhere in the neighborhood of $430,000 to $440,000 nationally as of the most recent reports. The National Association of Realtors chief economist has pointed to a simple explanation. Inventory is improving, but it's still below what would be considered a fully balanced market, so sellers haven't lost their pricing power. Think of it like a restaurant that used to have a 2-hour wait and now only has a 30-minute wait. It's a lot more comfortable to get a table, but the food isn't suddenly free. Here's a real-world comparison that makes this easier to understand. Imagine two friends, both trying to buy a home this year. One lives in Florida, where inventory has grown substantially and sellers are increasingly willing to negotiate on price or offer concessions like covering closing costs. The other lives in the Northeast, where inventory remains tight relative to demand and sellers still largely call the shots. Same national mortgage rate, same Federal Reserve, same news headlines, but two completely different local experiences. That's the part that gets lost when people only look at national averages. Real estate has always been intensely local, and in 2026 that's more true than ever, with places like Florida, Texas, and Arizona offering buyers meaningfully more negotiating room than the Northeast or Midwest. So now let's get to the actual question in the title. Should you buy a home right now? Here's the honest answer, and it's not the exciting, dramatic answer you might expect from a headline. It depends on your own financial situation far more than it depends on guessing the Fed's next move. Let's break down why, using simple math anyone can follow. On a typical mortgage today, the difference between a 6.5% rate and a hypothetical 6% rate on a $400,000 loan works out to roughly a couple $100 a month in payment. That's real money, but it's not typically the difference between a home being affordable or completely out of reach for most buyers. What actually swings affordability more dramatically is the price of the home itself, your down payment, and how stable your income is. In other words, the specific house and your personal finances usually matter more to your monthly payment than whether the Fed cuts a quarter point in September or December. Here's the psychological trap a lot of buyers fall into, and it's worth naming directly. People convince themselves that if they just wait a little longer, rates will drop enough to make everything click into place. But we've just walked through why that's not a safe bet to build a plan around. Rates already spiked back up once this year when almost nobody expected it. Waiting on a specific rate target is a bit like waiting for a green light at an intersection with a broken traffic signal. You might get lucky, or you might sit there indefinitely while the market moves without you. That doesn't mean you should rush into a purchase you're not ready for either. This is where the real lesson of this whole story comes together. If your income is stable, if you've saved a solid down payment, and if you plan to stay in the home for at least 5 to 7 years, the current environment is actually workable for a lot of buyers, especially in regions where inventory has grown and sellers are more willing to negotiate. Refinancing later, if rates do eventually drift down, remains a realistic option down the road, the same way homeowners refinanced after previous rate cycles. If, on the other hand, your job situation feels shaky, your savings are thin, or you're planning to move again within a year or two, then this particular moment, with rates still elevated and forward guidance from the Fed essentially gone, might not be the right window for you personally, regardless of what any national headline says. Here's the bigger picture forming behind everything we've covered. The Federal Reserve under Kevin Warsh has deliberately chosen not to hand markets a script. No promises about the next move. No forward guidance keeping everyone comfortable. Just data, meeting by meeting with a chairman who didn't even commit to his own rate projection. That approach is going to keep mortgage rates a little more unpredictable than they've been in the recent past, at least until the committee finds more agreement among its own members. At the same time, the housing market itself has been quietly rebalancing underneath all the noise about the Fed. More homes are hitting the market. Sellers, particularly in fast-growing regions, are losing a bit of their edge. First-time buyers have been slowly regaining a foothold, making up a meaningful share of transactions again after being squeezed out during the tightest years. Put those two forces together, and here's the real lesson of this video. The Fed didn't change the housing market by cutting rates or raising them. It changed the housing market by removing the certainty everyone had grown used to. And that uncertainty, more than any single rate decision, is what's actually shaping how buyers, sellers, and lenders are behaving right now. For anyone trying to decide whether to buy a home this year, the smartest move isn't trying to outguess the Federal Reserve. It's understanding your own numbers cold, know your real monthly budget, know how long you plan to stay, know what inventory actually looks like in your specific market, not the national average, and then make your decision from there instead of from a headline. That's the real insight most coverage on this topic misses entirely. It's not about predicting Kevin Warsh's next move. It's about recognizing that the Fed itself doesn't have full clarity on its own next move either, and building your decision on solid personal financial ground instead of waiting for a signal that might not come anytime soon. I'd genuinely like to know what you're seeing in your own area. Drop a comment and let us know whether your local market feels like it's favoring buyers or still favoring sellers right now, and whether this changes how you're thinking about buying. If this video helped you understand what's actually happening with the Fed and the housing market, do me a favor and hit subscribe to the Daily Finance and turn on notifications so you don't miss what we cover next, because this story is far from finished and the next Fed meeting could change the picture all over again.